The S&P 500 is down 14% year to date, and it's actually down over 20% peak to trough, which constitutes us as currently in a bear market. Now, that is a lot of loss to deal with in such a short space of time, and it can seem even worse on a day-to-day basis. And even with that, the market still feels like it could go a lot lower yet. I'm going to tell you a different story today though, and it's not all about scaremongering because there's a stock market crash coming. I'm here to say that even if there is a lot more short-term selling, it's not necessarily a reason to worry. A reason to adjust your portfolio? Maybe. An opportunity to buy in at ETFs and index funds at a massively low price? Definitely. But worry? Probably not. So here today I'm going to show you the top 3 reasons that you shouldn't worry about a stock market crash. Number 1, not all bear markets are due to poor economic conditions. There are lots of people questioning current economic conditions, but bear markets are not always due to economic weakness. More often than not, they just reflect panic, because psychology has got the better of people investing in the market. In 2008, it was definitely down to economic weakness and the wake of the subprime mortgage meltdown that affected all of America and the whole economy. Of course, this wasn't the case in March of 2020 when everything was down to COVID. While the economy definitely did suffer, this wasn't due to economic weakness, and it was more to do with the logistical struggles of the lockdown that occurred. The economy was doing fine before the pandemic took hold, and strangely enough, we actually came out stronger the other side. Now, yes, there was lots of money pumped into the markets, there was lots of stimulus in America, and there was lots of support given to people in the UK, which could have synthetically inflated the stock market. But again, this wasn't really due to economic problems. It actually only took the S&P 500 about 5 months to recover from a 33% drawdown, which happened just after the COVID outbreak. Even more shockingly, the S&P 500 almost doubled between March 2020 and December of last year. Now that shows the strength that the economy had during that period. 2, market crashes pose unbeatable buying opportunities, especially if you're a long-term investor. Many investors are guided by psychology, and that's the wrong way to approach long-term investing. We tend not to think logically when we see our portfolios go from £10,000 down to £5,000 in a matter of weeks. And as I'm sure you've seen, there are lots of people currently spouting the worst case scenario and suggesting that perhaps you should hold cash on the side and wait to invest at a lower point. For me, when stocks, ETFs and indexes are down, buy more. Now, this obviously doesn't mean you should just blindly buy into anything when it has a red day. You've got to continue to follow your normal strategy. If you're investing in a company and nothing about that company has changed but the price has fallen, that's a great time for you to buy more in and then hopefully reap the rewards in the future. Of course, if there has been a wholesale change in the company, you should review your investment strategy and perhaps remove it from your portfolio if it doesn't meet your investing goals anymore. However, if you're investing in broad globalized index funds or ETFs, much like myself and probably many of my viewers, then you should continue to pound cost average into those investments periodically throughout the year. If you're a long-term investor and you're investing back in 2008, you're probably regretting not investing more throughout that time, because we're now head and shoulders above where any of the markets were back at that point. Equally, in March 2020, I was quite fortunate and managed to invest a lot of money then, but if you kept money on the sidelines because you worried it was going to go even lower, you missed out on one of the best buying opportunities that any of us have seen in investing. Take this comment from Chris Smith, who says that in the year 2037, we'll all be wishing that we could have invested more at the 2022 price. And I think he's going to be exactly right. That's 15 years in the future. If we go back 15 years, look where we were then. I know that there are lots of people out there who started investing this year and probably 15 to 20% down. But if you continue to invest every month, you're pound cost averaging at a low point. So really, the only way is up. Whilst it's probably difficult to look at your portfolio, it's actually probably one of the best times to start now. It might still go lower, but you're still going to be buying in at that low rate. It's all about changing your psychology and flipping it on its head. Like Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. And this is a time where there's lots of fear in the market. So if we listen to the big man, we should all be investing. And finally, point 3 why we shouldn't worry about a stock market is that historically we have always recovered. Exactly 0 of the previous recessions and previous stock market crashes have resulted in a complete capitulation of the stock market. Even if it does take a long time, 10, 15 years to recover, the stock market historically has always recovered. Now, of course, past performance is not indicative of future return. However, the only thing we've got to go on here is previous performance, and that would suggest that it will be alright at some point to come. Since the great crash of 1929, the stock market has crashed to a bear market 12 times. And in addition to this, there are countless blips, corrections, and 3 or 4% falls or gains within certain days. And get this, despite all these stumbling blocks and hurdles, the S&P 500 is up 23,000% in that time. Now that is something to celebrate. Now, of course, you're never going to be able to invest for almost a century, which is essentially what 1929 is now. But it does show that by holding, continuing to invest, history shows that you'll be okay. And if you still need a bit of comforting, research shows that after a bear market hits the bottom, it usually recovers up to its initial value within 1 to 2 years. So if that is the case and it takes 2 years or 24 months for us to get back to a time where we're kind of breaking even, that's 24 months that we can continue to invest in at a lower rate. And we might not have even hit the bottom yet. That could be another 6 months in the future. So we could have 30 months of stock market sale. That seems too good to miss. I think the most important thing here is to not think too hard about investing. There's a reason why you're doing this, and that's to support yourself in the future, maybe to get a new house, maybe to give you more time, that you can quit your job early, whatever it is. You're investing for a particular reason. Yes, the stock market goes up, but it also does come down. And this is part of a natural market cycle. If you stay up in your head too much and you think too much about what you're doing, you'll talk yourself out of investing. As humans, we're greedy individuals, and because of that, I think we always want to try and get one over on the stock market. We want to try and beat it. We want to stay out of it just one more day so we can buy it at 50p lower. When, if you think about it, just get your money in there now. It's not going to make that much difference in the long term, and you might miss out on a 4 or 5% jump in a day. So my advice would be to consider your investing horizon and what investments you hold. If you're in crypto and you can't stomach 90% losses, maybe you shouldn't be in crypto. For me, crypto makes up a very small percentage of my portfolio, and you know I invest in ETFs. And that's the sort of thing that no matter the price, if it's up, if it's down, if it's just staying level, continue to buy in. That's the best way that you can profit throughout a market pullback. I think the key thing here is not to worry. We all know that videos and articles with clickbaity, fear-mongering titles are always going to draw viewers and readers in. And this preys on people's fear and makes them doubt their own investing decisions. The best thing you can do is just to ignore all the noise, continue doing what you're doing, and know that historically the stock market always comes out stronger in the future. With that said, guys, I hope you've enjoyed this. If you have, please do drop the video a like and drop a comment down below as to what you're worried about in the stock market at the moment. Are you continuing to invest every single month, or are you perhaps holding cash on the side because you're worried about more drawdown in the future? Let me know in the comments down below. And equally, if you haven't yet subscribed to the channel, please do consider subscribing to catch all my future portfolio updates and everything else to do with my investing journey. Also, as I've suggested, I've got some match betting videos coming up very, very soon. Match betting is a method that I've used to make over £10,000 in tax-free cash. This is using bookmaker offers against them, which can realistically make you an additional £400 to £500 every single month. With gas bills and the cost of living rising for that matter, and just petrol, it cost me 90 quid to fill up the other day, why not make yourself some extra cash now? Probably help you out. If you want to do it, check out one of the videos up above. I've got a link down in the description below to the software that I use called Profit Accumulator. And with that said, guys, thank you again very much for watching, and I'll catch you in the next one.